Hey guys, it's Ash. The stock market rallied at the end of May. The S&P 500 gained 5% and many growth stocks went up a lot more, so investors have decided the crash is now over. We have had 3 big green days, so it's time to pop the champagne and get ready for your stocks to go all the way to the moon. Except when you zoom out on the chart and realize that the 20% gain by Tesla is relatively meaningless when you look at the big picture of what happened throughout this year so far, and your favorite growth stock might be up by a third, but you zoom out and realize that that is all just noise. And the worst bit is that it may well get a lot worse before things get better. I know that the popular thing to do on YouTube is to declare that you have all the answers. You are the prophet, the oracle, the messiah, you have all the secret keys. Right now is the bottom. Go and buy the dip. This kind of thing gets the people going, even if you have declared the bottom twice in the last 3 months, and then even made yourself congratulatory videos saying how much of a market timing genius you are just before the stocks all went down a whole lot further. And unfortunately, I do not know exactly when the market will bottom out, much like all the other YouTubers that like to pretend to know but have exactly zero idea. I like to operate on likelihoods, and unfortunately at the moment, in my opinion, for me, the outlook is that it probably is going to be pretty ugly, pretty bumpy for a little while. And in this video, I'm going to share a whole lot of information that I am using to base this opinion, information that I think is quite pertinent to try to understand where things may be going. There are a lot of different competing issues at hand. We're going to talk about inflation, development of several different key drivers, the movement of post-COVID economy and the problems associated with that, and the massive looming energy crisis that is brewing on the horizon. Now, in just a few days, on Friday, June 10th, the US Bureau of Labor Statistics will publish the May Consumer Price Index data, and analysts are salivating at the prospect of inflation having already peaked and being on the way down, because in April, you see, inflation was only 8.3%, and in March, it was 8.5%. So we are now past the peak, and the consensus seems to be that May data will be 8.3% again, or maybe even 4%. But there are not 1, not 2, 4 major problems that I don't really hear many people raise often at all. And these problems may mean that inflation could well get ugly over the summer months, and the data that we have now is somewhat supporting it. The first problem is very simple. It is the power of compounding. Because if you zoom out just a little on the US inflation chart, you will notice that in April 2021, just over a year ago, inflation started skyrocketing. It went from 2.6% to 4.2% in just 1 month. But then if you zoom out even more, you can see what happened before that. Because in April and May 2020, inflation took a nosedive down to 0.3% and 0.1%. Because that is when COVID hit. The whole world went into massive panic mode and everything shut down. Governments were busy setting up their money printers and dishing out endless business subsidies. So when you look at inflation data back in April and May of 2021, you are comparing those months to the same months 1 year before. And the year before 2021, in April and May 2020, we had that massive suppression by over 1% compared to the months either side of that dip. This is what's called the lapping effect, and it is always surprising to me how few economists seem to actually understand and consider what this means, at least the popular ones that you get to see on CNBC and other such places. Inflation is not an absolute statistic, it is a relative measure. You are comparing a month this year to the same month last year. So when we had a big drop in inflation in April to June 2020, we then saw a very fast rise in inflation when we lapped those months a year later in 2021. The reality is that inflation wasn't necessarily jumping, it was just some artificial suppressants, artificial ways that inflation is being measured. The reality is that inflation wasn't really actively increasing just in those months and not before or after. It was increasing actually quite a lot during the summer of 2021 when that chart was flat, and this is why. In April 2021, inflation went up relative to a month in 2020 when inflation was artificially suppressed in the short term. If inflation in April 2020 was not suppressed, if it was just roughly the same 1.3 or 1.4% as it was, say, in March 2020, or even 2.5% as it was back in January 2020, then the April 2021 inflation figure year would have been much lower. Instead of 4.2%, it could well have been 2 to 2.5%. And the same thing then goes for May 2021 and June 2021. But then you have this bit in the summer of 2021 when inflation stayed flat, except that flat period was very consistently higher than the same period a year before. So every month during that period, the price growth was continuing and the net impact on prices of goods and prices of services was accelerating. So now we're in 2022. And here is the really important bit. This lapping effect works both ways. Last year in 2021, March jumped up from 1.7% to 2.6%, and in April, it then jumped from 2.6% to 4.2%. And if we're seeing a steady long-term inflationary effect, then in April and May this year, we should be seeing a slight dip in inflation, even if prices are rising and the rate at which they are rising is increasing. Are you following this? When the same period last year sees a fast run-up, you would expect that then, everything else being equal, the same period this year would take a slight dip because the rate of the increase is what matters. And this year, April did dip down to 8.3%, which is actually a very small dip given the rate at which April was growing last year. And the consensus on the forecast is that May will also be at 8.3%. So May then will not dip at all if we hit consensus, even though May last year was still rising very fast. So even if the consensus is right, and it has been too low pretty much every single month recently, even if the consensus is accurate, it is still a really bad sign, despite all the media probably celebrating it if it happens. Because look what happened in the summer last year. 5.4% in June, 5.4% in July, 5.3% in August, back to 5.4% in September. And if we're continuing along the same non-linear upward inflation curve, we may well see inflation actually sitting flat somewhere around that above 8% mark and then pushing towards 10%. And then when we're lapping October onwards, that's when inflation went on a run last year, and we may be in for a real shock this year. And of course, everybody will be massively surprised if late on in the summer and heading into the winter season, inflation suddenly, for no apparent reason whatsoever, goes completely off the charts. And the problem actually gets a lot worse, because there are several compounding other issues at play. First, here is the calendar of the Federal Open Market Committee meetings. These are the meetings when the Fed decides on interest rates. We have one coming up in June, just after the inflation numbers come out. Then we have another one at the end of July. And all the heads of the Fed Bank over the last couple of days seem to be in absolute agreement that they will increase rates by 0.5% in each of those two meetings. And on paper, that might even look kinda good. The rate will go up to 2%, and inflation may well be hovering around that 8.5% to 9% mark, and everyone will be praising Jerome Powell's measured and very smart, steady approach, because it will look like the policy is working at some point in mid to late summer. Inflation will have been contained. The rates are steadily rising and are already working. This is the magic, the first time in history when this type of policy has ever worked. Not putting the brakes on the economy, but helping inflation come down. But then, we only have 3 more meetings planned for the rest of the year. The September meeting comes on the back end of that summer inflation plateau, so it's fairly probable, although who knows, that we won't be seeing much going on yet. And what happens if October numbers come out and inflation goes above 10%? Suddenly, it will look like maybe inflation didn't just go away all by itself for the first time in history. I know, very surprising if that happens. And everybody will actually suddenly be massively surprised by this fact. The Fed will be looking at inflation in the double digits and potentially heading higher faster than expected. And the rates will be at that point at 2 or 2.5%. At the same exact time, the winter season will be upon us, and Europe will be scratching their heads trying to figure out how to actually survive the winter without using Russian oil and gas. Because remember, in the last couple of days, the EU just agreed to block all shipped deliveries of Russian oil and gas, and many of the bigger countries have also agreed, including Germany and Poland, to turn off the pipelines as well. Now, oil and gas are currently at historically massive price levels, and the pressure in the coming months over the winter season again in next year is probably not going to help those prices. But at the same time, we'll eventually have to have shelter prices come through in the CPI as well. Every month that passes, housing prices and rent continue to grow at a somewhat bonkers pace. The Zumper report continues showing rents that are growing 12 to 14% year on year, month after month after month. The St. Louis Fed data is showing that the house prices are exploding, and yet the CPI for the latest available month in April is showing that shelter is growing at only 5.1% a year. This metric is delayed from the actual price of shelter because it is based on surveys. It is based on people's feelings, people's opinions, but also it takes time for higher rents and higher mortgage prices to fully propagate into actually affecting people. Because if you're on a fixed term mortgage, if you haven't moved house, if you haven't rented a new place, you may well not be impacted despite the prices going up. Eventually though, this measure will go up, and the longer that the lag is between the actual prices increasing and when the measure goes up, the higher it will have to go to catch up, because it will have to make up for being lower than the real increase in costs in that intervening time over a longer period of time when the rises were going up cumulatively. So at the moment, property prices are going up at about 20% year on year, and rents at maybe 12 to 15% depending on which report you look at. So there is every chance that shelter will begin creeping up towards that 15% mark at some point as well. And shelter makes up a third of the total CPI index. And if shelter is at say 15% and it is a third of the index, or at least pushing towards there, and energy is at say 50 or 60%, and energy is another 7.5% direct in the index, probably another 7 to 8% indirect, it will be pretty much impossible for inflation to be below 10%, almost regardless of what everything else in the CPI does. And then we get into the worst problem, because everyone is worried only about the absolute level of inflation, but the level of inflation is only one half of the story, the smaller half. The bigger half is the length of time that you are sitting at that high level of inflation. Because a few years of consistently high inflation can be much worse than a short spike that then goes back down to a lower level, because inflation multiplies. It takes effect continuously over time. If you have 2 years at 10% inflation, then the cumulative effect is that prices do not go up by 20%, they go up by 21%. And if everyone is patting Jerome Powell on the back this summer because inflation is apparently being curbed but still staying put at that 8.5 or 9% level, we will see potentially the inflation wage spiral take effect. And this is where it gets really, really bad. If your wages do not go up for a year and prices go up by 10%, things are pretty bad. It's not the end of the world. You have less disposable income, you're spending a lot more money on paying bills, but you can maybe make ends meet, especially energy and food bills that are going up way, way faster than inflation at the moment. But if you don't get a wage increase for 2 years and prices are now up 21%, you get into a place where push comes to shove. And there is a good chance that if the situation plays out this way, then when we get to Q3, when prices are continuing to climb, we may well see one heck of a push on salaries. And this is where it can get extremely dangerous. If salaries start growing at rates far in excess of the Fed rate, you run a very real risk of inflation not needing fuel to burn anymore. This is critical and one point that many people often don't really understand. You can get into a self-propelling nuclear explosion that nobody can any longer control except some extremely urgent action by the Fed. There are definitely a lot of good reasons why the US inflation can't follow the path of Venezuela or Russia or many other countries that experienced hyperinflation in the past. But some of these reasons are losing weight in front of our eyes. We have China and Russia now happily trading oil and gas without using dollars, for example. And I expect that the Fed will probably begin, at least I hope they will, taking much more urgent action than it has been if inflation starts to get near to or cross the 10% mark. Because maybe, just maybe, the obvious issue will become even more obvious to a point where the chairman of the Federal Reserve realizes that it's kind of his job to actually do something rather than sit there scratching his ass. Although just 6 months ago, the same person was telling everyone that this time it is completely different and inflation will definitely just go and disappear all by itself because it's transitory. So who knows? So my top tip here is to buckle up. I have no idea which way things are going to go. But it is definitely looking pretty choppy out there, and it could well get a lot worse before it gets better. If you found this video useful, please don't forget to smash the like button for the YouTube algorithm. Thank you so much for watching. I really appreciate it, and as always, I'll see you guys later.